Welcome to Money Manager. In the studio with me this evening is Victoria Reuvers from Morningstar. We're talking about the Foord, or is it Foord, balanced fund. It's 50-50 with me. Some people say, no, Lindsay, it's Foord. Let's say Foord, shall we?
Lindsay, I believe it is Foord.
Okay, Foord Balanced Fund. Tell us about it. Foord, not legendary, but certainly well entrenched in Cape Town asset management history, along with 3 or 4 others. And this is a well-established fund. How's it done?
This fund has done exceptionally well. It was founded in 2002, so it boasts one of the longest track records for managers in South Africa. At Morningstar, we actually typically place very little value on performance, given manager tenure is so short, on average 5 years.
Yes.
But this is a fund that Dave Foord started the business in 1981, and this fund founded in 2002, and he's been managing it since then with Dane and Daryl Owen and Dane Schwan. Performance has been exceptional. If you look over the last 10 years, there's only one calendar year where it has been behind benchmark, and that was 2007. And they've proven to be excellent.
That was a tough year for everyone, wasn't it?
Yeah, it was. The fund held up very well in 2008, and particularly over the last period, it's done very well.
Do you assign their wealth to their creation of wealth to the fact that there has been a good, solid management team that has been there for more than the 5 years that you spoke about? Has there always been a consistency and a great succession plan?
Yes, in fact there's a very low turnover of staff and personnel in the business. On average, the managers have been with the business for 10 years or more. And in 2009 they implemented the multi-councillor approach, which removed a lot of the key man risk that people were concerned around, Dave managing the majority of the assets, and that multi-councillor approach has worked very well.
Okay, let's go to asset allocation now, because if you look at this, I mean, the latest information I have, Victoria, is equities. Let's call it 59% of the total, of which 38% is domestic, and the rest is foreign. They're not quite up to their 25% foreign, which I find quite strange.
In fact, given the recent currency weakness, I think they may have drifted over. The reason why they're not at their 25% foreign in equities is that they invest in their Foord International Trust and the Foord Global Equity. And the International Trust is a balanced fund. It can have 70% in equities, 30% in fixed income, which would result in the less than 25% in equities offshore. So over the last few years, while a majority of managers have been underweight domestic equities, Foord is the one house that has actually held a relatively full weighting or exposure to domestic equities. They have cut that back of late, but they do rely heavily on their equity capability to deliver long-term returns.
But of course, when we say domestic equity, 38.4%, the precise number that we're talking about now, you've got Steinhoff, which is, it's local, but it's international. You've got Richemont, it's local, but it's all international. British American Tobacco, exactly the same. Standard Bank, the same, and Sasol, I suppose. So although it's slightly less before the currency factor in overseas equities, its local equities essentially push it much higher.
Absolutely. And a key focus for them on their equity selection is, are they happy to forego a price discount so long as there is earnings visibility, a good free cash flow, a solid management team? And I think this is represented in their stock selection. So again, where they are slightly different from a stock selection perspective is they do take macroeconomics into account. They tend to marry value with the cycle. And as a result, you can see they're very underweight domestic equity shares. That hasn't always been the case. In 2009 up to about 2012, they were relatively overweight retail shares, which was very good from a performance perspective, and they looked very different compared to competitors, but that position has been reduced substantially.
It's interesting because a lot of people come onto this show and they have a very specific view. They're stock pickers. It's bottom up. There's nothing to do with top down. Macro, they don't care. They don't watch television. They don't even know what the oil price is. They don't even know who the chairman of the US Federal Reserve is. I'm exaggerating, of course, but it's nothing to do with them. But Foord rather, is different.
They are, Lindsay, and they are aware of, although they are not trying to predict what's happening on the macro environment, they're aware of how macro trends can influence valuations. As much as their stock selection and what they own has been good, I think one of their key drivers has been in what they've avoided. And that does take into account being aware of macros. So they have had no exposure to the diversified miners. They've been very underweight resource shares. In fact, 6% of the portfolio is exposed to resources, which is predominantly through Sasol. And not owning those areas of the market, although valuations have been good, has been a big differentiator in performance.
I've been boring people to death with my analogy about what to leave and what to hit. I've been saying to people, and I didn't realise this until I started doing this Money Manager show, how important it is, not just for the stocks that you hold, but the stocks that you don't hold, for the performance of a portfolio. And it's like a cricketer, a good cricketer, like the England captain Alistair Cook, knows when to leave a ball. And the balls that he leaves are as important as the ones that he hits for four. Same with fund management.
It's a good point, and I think one that's often overlooked. So the fact that they have been very underweight and had no exposure, mainly because there is no earnings, and they do feel that there are too many macro headwinds, and that has resulted in a significant performance differential in the market.
Okay, so it's a balanced fund, and
Yes.
it is well balanced. 38% domestic equities, 21% foreign, increasing now because of the demise of the South African rand. Money market is the next one, 19%. That seems quite high.
It is, and protection of capital has, in speaking to the managers of late, has become front of mind. So while cash may not be offering you any significant real returns, given the valuations of the broader market, they feel it is a good parking bay. Having said that, when bond yields sold off, they did start increasing their exposure. At 8.5% yield, it was more attractive than cash, but yeah, capital protection is front of mind for them right now.
Yeah, government bonds only 1.3%.
I think
Have they lost out? Have they lost out? I mean, has it gone from a higher percentage to a lower percentage because of the perceived rise in interest rates and therefore the rise in yields and the fall in bond prices, or have they always been relatively underexposed to what has been the most spectacular bull market for many years?
It's a very good point. And if you look at their performance, the fact that they haven't been as aggressive in asset allocating or in allocating money to fixed income, particularly government bonds, it is really impressive how well they've done.
Yes.
And you're right, they have missed out. But as mentioned earlier, they do rely very heavily on their equity capability.
Yeah, well, also corporate debt is up there at 10%. I mean, corporate issuance can be terribly, terribly attractive. There's not a lot of paper out there, and there's a lot of people, especially the fund managers in this area in Cape Town, all looking for that corporate paper. But they've got 10% up there, and that seems to have done well for them as well.
It has. It's relatively short dated. They've held it for a while, so obviously the duration has come down, and it just gives them an extra yield over cash.
How often do you see these people? Let's get into the Morningstar approach to a company like Foord, because this is your job. You're not looking at the fact that they've got Steinhoff and Aspen and companies like that. You're more interested in the process. You're not that much interested, although it's important, in the previous performance. You're looking more to the future. How often do you sit down with a company like Foord and say, Mr. Foord, when are you going to retire and who's going to take over, that sort of thing? Morningstar
have a very robust investment process or research process that is used throughout the world. And in comparing a German bond fund, you can like for like compare it to a South African fixed income fund. How often do we sit with the managers? Well, we actually did a very thorough due diligence with Foord, I think it was 2 months ago, which was a recap.
Yeah.
It's a detailed process, and the most emphasis is placed on the parent, the process, and the people. It's a 5P process. Performance and price are the last two pillars, and performance does carry the lowest weighting within our evaluation metric. We go through an incredibly detailed process, and as mentioned, the parent pillar is where we spend the most time. So we did get a lot of comfort from the work we did with them. We spent several hours in their office, and we got to see the entire business. So we were very pleased. On an ongoing basis, we have regular contact with the managers. So
it's the company itself as well as the people running the fund. You don't take the fund in isolation. You have a look at the philosophy and the DNA of the company as a whole.
100%. It's so important at a parent level to know, are these 10 years from now, if we allocate investments to them, are they still going to be good stewards of capital? Are they more interested in growing their revenue base? And one of the key factors we look at and where we rated Foord very highly, well, actually two metrics, were one, the amount of co-investment by manager in the funds. It's one thing to have share options, but then you'll do better if the fund does very well, if the business does well through revenue. We like managers to have more skin in the game, and Foord does have a very high level of co-investment. And the second is, given their very good performance and success over the last few years, we were pleased to see that they have kept their fundraise limited. They haven't used their success to launch a number of new funds. In fact, they've kept it towards their core capabilities, and there's only one new fund that they've launched, the Foord Conservative.
Yeah, it sounds conservative, but also quite progressive. The other thing is, if you're a share activist, for example, if you, for example, have 22%, you're a big fund manager, you've got 22% of a relatively small or medium cap stock on the JSE, and this company wants to make an acquisition, you go in there as you know, significant minority shareholders, and you sit down and say, why are you doing this? I don't like the fact you're doing this. Can you explain this? We might vote against it, whatever the case may be. Do you, as Morningstar, for example, if you suddenly saw that the domestic equity exposure was up to 55% and foreign had come down to 10 or something like that, would you say, wait a second, what is this all about? And you would phone them up and go and see them?
Hopefully we would know before that happened.
Yeah.
We would be aware of what was happening. The work we do is very forward-looking, so to date we haven't been surprised by any changes at a portfolio level of any of the managers that we produce research on. But you're right, if something seemed out of the ordinary, we absolutely would speak to them. Just on that shareholder activist side, Foord, interestingly enough, are very active at a board level. PPC is a good example of that, although not a share that really worked in their favour in the end. Management were very involved in all of those dealings.
Yeah. Okay, so this is a fund that you recommend. You
Yes.
keep on monitoring it, and it's continuing to do well. Hopefully, will continue to do well in the future. Just on their macro approach.
Yes.
And I said, you know, a lot of funds don't watch television and don't know who Janet Yellen is. Are you aware that they would say, for example, see the oil price going below $50 a barrel, have a look at the Sasol share price and say, okay, it's Sasol versus it's macro, it's Rand versus oil price, it's Sasol versus Rand oil price. Is it a really big part of their equation?
No, they're not traders in the fund, so they wouldn't make, in my opinion, short-term decisions around movements such as that, but they would pick up longer-term trends. So, for example, if it is likely that they anticipate interest rates in the US to rise, they have, as a result, zero exposure to global government bonds.
Victoria, we'll have to leave it there, but thank you very much
All
for
right.
popping in this evening.
Thank you, Lindsay.
That's Victoria Reuvers from Morningstar. We've been talking about the Foord Balanced Fund.